got a few minutes, so I'll only be able to whet your appetite about image resources. I will be brief. I will even skip some slides. We've got a booth just out the door at P90. Please come and talk to us. This is not about an exploration play. This is about a production mining, a company moving from exploration to production. You'll see here it's 100% owned, a project that we're putting into production this quarter, and it's mineral sands. I have a little bit of information on mineral sands commodities for those that may not know about it. I will fly through it and keep on to the main potential investment opportunity with image resources. As a summary, I've got a couple of slides. First one is that this is about a company that's now fully funded to first production. And that first production is going to occur between now and the end of this year. We're even fully funded through to positive cash flow, which is forecast for the end of the first quarter in 2019. The metrics, the financial metrics on the project are as shown here, a NPV of $235 million, a very, very high internal rate of return and a very fast payback period, partly because the total capital cost to get into production was only $52 million on the ground. Company market cap currently $133 million and share price 14 cents, actually a little softer this week at about 12.5 cents. And as you'll see as we go through this, we have a pretty clear picture that suggests that the enterprise value and the overall cash flow potential of the project can push the market cap considerably from where it is. This slide and the next one tell you a little bit about our commodities in case you're not familiar with what mineral sands commodities are. I'll only tell you that there are two categories, zircon and titanium dioxide minerals. Zircon, as you can see here, used for a number of things, principally ceramic tiles. I'll let you read this from our website or come by and talk to us at the booth. And the titanium dioxide product principally used as an ultra-white pigment in paints, plastics, and paper. But as you can see here, a number of other opportunities for the metal to be used. Common use products generally grow in demand and price with the GDP of the world. The location of the project is extremely important. This is in Western Australia. The project is effectively just a little over an hour drive north of the CBD of Perth. That means we're an infrastructure country. We have access to people and all of the resources that we need. This is a situation where people will go to work in the morning from their home and go back home at the end of the day. No camp, mining camp, no fly in, fly out. In this area, we've got a fairly large portfolio of prospects and projects, some accessible by mining using dry mining techniques, which is what Boon & Arring, the project I'll be telling you about, is all about, and some accessible by dredge mining, which means the ore is below the water table. And there is at least one project in the dredge mining that's my front runner as the potential phase 2 growth of the company as a second operating center, but I won't talk about that today. This is about the Boon & Arring and Atlas projects that have a combined mineral ore reserves here, as pointed out. The key about this is that this is a high-grade play. From the standpoint of heavy mineral, it's 2 to 2.5 times higher than what I would call a standard grade mineral sands project. It's very high in valuable heavy minerals, which means very little trash components. And lastly, in particular, Boon & Arring, very high in zircon. Zircon is the value driver in a project like this. It represents about 75% of our total revenue. And as you'll see, we're getting into production at a time when the zircon price is climbing very rapidly. These graphs are used to just show that in the ground what the assemblage of the 4 main commodity products are. And you'll see it's predominantly ilmenite, 66%. But you'll see that on the cost per ton, or the value per ton, the higher value one is zircon. When you add those together, what it shows is 73% of our revenues coming from zircon. Base assumptions here, I'll only touch on one part. It's a relatively small operating mine and processing facility, 500 tons per hour. However, because of the high grade and the high zircon value, on a revenue basis, it punches about 4 times above its weight, and more like a 2,000 ton per hour project because of the high grades. a quick snapshot of the quantity of the various products that are in the concentrate that we're producing and selling. This one actually, again, I won't spend a lot of time on, just highlights that in the first 5 years of production, the very high heavy mineral grades and the very high zircon and the amount of zircon being produced. And then on the overall financial metrics, it highlights the total revenue, the margins, which is very important, and the project EBITDA. And I'll just say a couple of things. And in that first full 2 years, 2019, 2020, you can see that the margins are close to 90%. You can see that EBITDA is almost $150 million for those 2 years. That $150 million EBITDA is to cover a $50 million debt. So at the end of that third year, which is another 2.5 years from now, by the way, we will have paid off our debt, and we will have about $100 million in the bank that can be used to talk about dividends and or reinvestment, and I think we'll probably be talking about both. This is the snapshot of the financial metrics of the Bankable Feasibility Study as first published in May of 2017. It started out to be a reasonably buoyant project, but since that time, the price of zircon has been rising rapidly, and you can see here that as of June of this year now, the BFS has moved to over $235 million NPV. And this is the graph that plots the rise in the zircon price. And right at the very bottom is when we got started running the project through an advanced feasibility and moving to production. You can see the price has been growing very rapidly on zircon, not in 2 and 3% gains, but in 10 and 12% jumps once every 6 months or every 4 months. The latest jump you see there was in October 1. That puts the current price above what we're projected to be in the feasibility study when we start production this quarter. And then already, Tronox, which is the second big producer of zircon, is selling their product at an even higher price still. The last thing on this slide I'll tell you is that there has been a significant driver of this price being a demand deficit, a supply deficit. That supply deficit is predicted to continue through 2023. So we expect to see these prices continue to rise. Quick pictures to show you that we have been constructing now for 6 months. And as of last week, we made the announcement that we've moved to wet commissioning. So this is real. We commissioned the project on time and on budget. Dry mining operation. This is the schedule that simply shows, as we've been telling the market, we're stuck with it. We've started commissioning in October as we expected to, and we'll be in production before the end of the year. The key about this is we've told you about the financial metrics of our one project. But in our portfolio, we have a number of others, and even the current project is expandable. We've had some drilling already that showed that the high-grade zones are extendable to the north and to the south. And then we have a number of other projects in our portfolio that we can look to for our phase 2 growth. That's the two we're talking about in the feasibility. The others are projects that we can further advance as a second operating center if we so choose, or continuing the overall mine life in this area. And then from a dredge mining technique, we've got one project at the top is that my front runner. It's got some very special characteristics. It too could become a second operating center. We're even sitting on the potential of a small royalty coming from our big brother Tronox to the north because of some land that we sold them a few years ago, and that could be a positive royalty coming to the company. Lastly, a snapshot of the corporate structure. You'll see we still have a sufficient amount of cash in the bank. When we finish construction, we will still have about $10 million as a minimum when we get to positive cash flow at the end of the first quarter. So we are in a good position. Our spend on capital has been right on track so far. You'll see that our enterprise value here is $164 million compared to a market cap of $130. And in fact, this is now out of date. We've had another month of capital expenditure, so this will quickly be climbing to $180 million in enterprise value. I won't go through this one. Most of you know what these kinds of curves mean. They're just generalization curves. I just put on here where I think our value was as a share price and where we might be by the end of this year. That's for contemplation by investors. And the last slide before I close out is simply to say that while we are in infrastructure-rich country and are connected to grid power for electricity, we are also putting in a solar farm that will provide about 25% of our electricity from solar as a matter of having our green stamp from an environmental standpoint. That's totally at our choice. That's the story of Image. If you have any questions, please come by and talk to us at booth P90. Thank you.